So welcome you all for this special interview session, and thank you, Mr. Karthik Athreya, for being on board with BMS Bazaar, for giving this special interview for investors so that they have a good idea about next financial year as well.
My pleasure.
So Mr. Karthik Athreya is the Director and Head of Strategy of Alternative Credit, Sundaram Alternates. So when you say that, let us talk about the macros first. So you know what's happening in macros and for the US and UK banking sector under crisis. So do you think there is a shift of asset allocation now? So people are going more into debt than equity?
Yeah, I think that's a great question to get into the topic, Akshara. So I've been investing in various capacities over the last 22 odd years, and I must say that the last 12 to 13 years has been extremely eventful. Ever since we thought events like the collapse of larger than life institutions was not possible. But it's incredible that ever since the global financial crisis in 2007, there has been a consistent run on institutions which one would have thought would exist into perpetuity. So starting with Bear Stearns and Lehman, and now you see more recently Credit Suisse, the latest run on Deutsche Bank, the Silicon Valley Bank. So these are I would say extremely cherished, almost revered institutions which are falling by the wayside. That's a reflection of how rapidly market events are able to affect global business as we know it, asset prices as we sort of know it. And so consequently, there has been over the last 10 to 15 years, not just the severity of these events, but also the frequency, of these events have started to increase. And consequently, there are nuances in terms of new products, in terms of, product classifications, risk thresholds, that have started to play a role, in asset allocation, starting from large institutions like pensions and sovereigns, to very local retail HNI investors. So very clearly, this is a trend where, people have now started asking the right questions in terms of, what is volatility, what is your, as an investment manager, what is your risk threshold and tolerance, and consequently, how are you going to protect my capital, or what kind of risk-adjusted returns are you going to make? So essentially, from this perspective, I would say definitely that private credit as an asset class, it's relatively a new word, but I think, starting with bank allocation of capital over time to private equity funds, private credit funds, sort of NBFCs in the India context, have all participated in some form of private credit asset class. And this has now begun to gather significant levels of sophistication in terms of identifying risk, identifying investment mandates, and consequently, I think it is here to stay, as an asset class. So consequently, it is increasingly starting to figure, in asset allocations, as far as investors are concerned. Having said that, so investors from an India perspective, right, should be comforted in the fact that fundamentally, they are sitting, very enviously in a growth economy. So, one of the few growth economies in the world. One can argue whether it is 3% or whether it is 7%, but 3 or 7, a growth is growth. So this is a very unique situation where you fundamentally, whether you take a private equity bet, a public markets bet, basically, or even any kind of differentiated strategy, all bets inevitably are some format of growth equity bet in many ways. So from a growth capital perspective, it is a very unique market in the world, where investors have the benefit of perhaps, considering the global uncertainty and volatility, some level of, I would say, forgiving, from a local market perspective, where, the risks in some ways, are being compensated by the growth that the economy has to offer. Obviously, having said this, timing is of consequence. And so, obviously people lose money mostly, in a developing and an emerging market and a growth market on timing, because, obviously, India is not immune to global uncertainty and global events, whether it's geopolitical crisis, currency runs, asset bubbles, allocation of global capital, all of those play a role. But having said that, if an investor has time on his or her hands, inevitably they end up making, a return. What that return is and what the quantum of that return is obviously, up for debate. But, it's not true in other markets where capital can be wiped out. As you can see, one would have thought the Credit Suisse AT1 bondholders, and it is a bond, in a technical, in the finances, I understand it, a bond cannot lose money and get subordinated to equity, but that's exactly what happened, right? So, these kind of events, I believe that, in a country like ours, are largely forgiven. Even if you take recent crises on names like Adani and so on and so forth, I have come across so many investors, who still hold on to Adani stock because at the end of the day, it is a growth bet, where Adani is positioned as an infrastructure, they're building the backbone of the country and so on and so forth. I'm not batting for any particular name, but fundamentally from an investor perspective, they have that unique benefit as far as investing in India is concerned. So from that perspective, I would say, when an investor has to look at asset allocation in India, they do have choices today. Historically, of course, fundamentally considering the growth angle that I mentioned, equity seems to be the most obvious choice. But, we are increasingly seeing over the last 5 years, take the point of our own, private credit funds, which is a very young vintage, starting ironically in 2017, where we were at the fag end of demonetization. And then, we saw a host of regulatory changes, whether it is the GST, the Real Estate Regulation Act, because we have real estate credit funds. And then we had NBFC crises, which massively impacted liquidity in the market. And then we had obviously the two COVID waves, with the lockdowns and so on and so forth. And now we are on the brink of a massive inflation, rising rates environment. So considering all of this, our credit funds have continued to make money, continued to make cash distributions. So from that point of view, it is an extremely resilient economy. And there is a lot of flexibility that investment managers have to structure products, catering to the risk reward and the ideology that investors have.
So with that, I could take it as a gist saying that private credit as an asset class is having more attraction in India. So what is that gap that you see? Because private credit globally, it is very popular when compared to that in India. So where do you see that gap?
Okay, it's an interesting question because, it has 2-3 contexts to it. Just to put things in context, the global private credit market, as it is defined globally, is close to $1.5 trillion US dollars. It's a pretty huge market, and that's growing at 10 to 15% a year. Okay? By comparison, in India, the way Sundaram and personally myself, define private credit is an opportunity to invest where our borrowers or investee companies do not have the ability to access capital from banks, from private equity and public markets. Right? So essentially the three historical, I would say, capital providers in terms of markets have been public markets, followed by banks, which are the lowest cost capital providers in the country and the largest by volume. And the third is the increasing emergence of private equity funds over, let's say, the last 20 years. So anywhere where any of these three are not able to provide capital is defined as private credit, right? So historically, these used to be money lenders, curbside lenders, as it is called in the US, or loan sharks, or whatever terminology that the China market uses. But that has gradually and rapidly started to institutionalize in India with the emergence of private credit funds, non-bank finance companies, which have been in existence over the last, I would say, 10, 15 years. But of course, they are consolidating and moving into specific asset classes now. So essentially, it is I would say, slightly differently oriented market. Now, the gap, as you call it, from, let's say, global sizes, and here is sort of to put it in context on account of two things. One is the global private credit market is essentially, one is provision of capital, for a variety of corporate, wholesale uses. And the other is distressed type uses, where there are large portfolios. So for example, there have been hedge funds, there have been private credit funds, which have bought into distressed bonds, of banks, tier 2 debt, big portfolios, that banks are paring down. Deutsche Bank at this stage is selling billions of dollars of their portfolios into, private credit funds. So the access or the opportunity, is very different compared to a growth market like India, where, there is a demand, for capital to grow businesses, which is where funds like ours are positioned. So, one is the fact that the color of the private credit market is very different globally versus, emerging markets like India, number one. Number two, if you see the capital structure in terms of provision of capital in India, and I say this, this has been, a very significant point over the last decade, where I continue to think that roughly 80% of capital in India, purely speaking from a credit perspective, is being still provided by scheduled commercial banks. Okay? And the balance 20% is everything that we are discussing, as interesting opportunities in this market, which have been 10-15% NBFCs, loan sharks, private lenders, and private credit funds. Now, if you see the same percentage in terms of capital structure access in, let's say, the US, it is exactly the opposite. Where 20% of the capital is banks and 80% of wholesale credit requirement is coming from private lenders. So it is a dramatic difference in terms of how capital is constituted in developed markets versus emerging markets. And we consistently have seen this ratio being pushed to change. I'm not saying that, it is over the next 5-10 years, it is going to invert into the 2080, that developed markets has. But you can clearly see that banks with greater regulatory oversight, with more, I would say, rules and regulations and restraints in terms of what the RBI wants banks to do, what NBFCs are likely to do and already have done, ALM issues, and simply the ability to evolve in terms of credit appraisal and opportunities. We are consistently seeing that 15-20% number go up in terms of exposure. And consequently, we're seeing a gradual and consistent reduction in terms of, ability of banks and willingness of banks to go into, let's say, small market credit, mid-market credit, opportunistic type situations. I'm seeing in the news, Kotak, for example, has just raised a special situations fund of 1.25 billion. That is almost, quasi-credit. Where the opportunity is so large, that pension funds and, sovereigns and so on are increasingly looking to participate in this sort of structural shift of what's happening to the market in India. So, clearly, when we look at gaps, it is emerging markets like India inverting in terms of risk reward and how capital structure is being accessed in the market on the one hand, and the very nature of credit demand on the other, where there is bilateral growth capital requirements, which increasingly are being catered to by private credit funds versus banks. And not to say that banks will overnight get replaced, surely not. But clearly, the fact that, an 80% is, even if an 80% comes down to 60% in terms of where banks lend, that is easily, I would say, 5 to 10 lakh crores of annual demand in terms of, capital requirement for credit in India. I'm not even talking about private equity and public markets and that sort of stuff. So, on a $2.5 to $3 trillion credit market, any structural shift of even a couple of percentage points in terms of credit demand and the structure of capital constitution is a massive opportunity, for the country. So that's why, we are excited. We think this is sustainable. This is very long term in terms of a trend. And, there are increasingly likely to be emergence of, managers and a focus on this particular asset class.
So with having so much of opportunities in private credit fund, so there are a lot of sentiments of HNI clients as well. So how is Sundaram stepping in to satisfy those sentiments?
Sure. So look, I think the opportunity for Sundaram is no different than the opportunity for other investment managers in the asset class. So for example, if you see most of the private credit institutionalized in India is largely happening through the alternate investment fund vehicles. And particularly within that, the AIF category 2, which SEBI has designated for credit funds. So if you see the AIF industry itself, as a reflection of what I said in response to your previous question, is only 8 years old. So in less than a decade, it has gone from zero, particularly AIF category 2, to close to 3 lakh crores in terms of capital raised. Okay? That's a massive growth number of 30 to 50% a year, just on credit funds, right? And within credit, if you see the opportunity lies across individual sectors and asset classes like real estate, corporate lending, venture credit, and so on and so forth. So Sundaram or any other investment manager, would seek to get into those individual asset classes within private credit in a way that, they can deliver best value, to high net worths and so on. That's on the investment manager side. On the HNI, ultra HNI, even family offices, I would venture to say even the institutional investors, whether they are corporate treasuries, even banks, which have a mandate to put money into AIF funds, insurance companies, public financial institutions, even PPF technically has a mandate to invest into AIF funds. So from an access to opportunity, I think the government has opened up investment mandates for all categories of investors into private credit. So almost all of them, are looking at private credit as part of their asset allocation. Some are early in the game, some have more of an equity mindset, some would look at, some sort of a hybrid return, some look at it as an anchor in terms of stability to their portfolio, regardless of, what the, I would say, investment appetite or risk management or philosophy in terms of portfolio build is. Everyone is looking at some form of private credit today, which is a significant attraction, not just to Sundaram Alternates, but to various other investment managers in the business. From a Sundaram perspective, we are clearly, so every investment manager, as I said, has, a certain fund management philosophy, a risk threshold or tolerance, the way they do business and so on. We, our ultimate parent is Sundaram Finance, which is a AAA rated institution. So we come from a AAA mindset, so for us, every single sort of investment that we do, a fund that we launch, has to focus on three things. And in that order, we call it the three pillars. The first of it is capital protection, which is priority number one, where whatever we do, we would do on a secured basis, where we have comfort of collateral from hard assets, we are cash flow backed. So essentially we focus on performing credit as an asset class. And I'll explain in a minute, maybe later in this conversation, what are the various constituents of asset classes within private credit. The second thing that we look at is, most of private credit funds tend to be locked up funds, closed-ended funds. So from that perspective, we feel both from a risk perspective as well as from an investor perspective, we need to be investing in assets which throw up consistent cash. So the current yielding nature, we invest in companies that, pay us quarterly interest, for example. And that interest is fully distributed to our investors. So there is a very active current yield and annuity feature built into all our credit funds, that, we place as the second important piece of consistently providing liquidity so that the investor sees that the portfolio is churning cash. And from a risk perspective, the risk is consistently coming down. The third feature is risk-adjusted returns. When one looks at the end of the day, an investor is going to pick an asset class fundamentally based on returns as well, right? So from that point of view, our goal is to provide risk-adjusted returns where if the fixed income universe in India is ranging between, let's say, a AAA GSEC, which is 6.5, 7.5 gross yield, to sort of a triple B, which is between 7.5 and 10, 11%, to, whatever else, maybe, much higher down the risk curve. Our goal is to create senior secured portfolios which are consistently cash paying and, risk mitigating, which distribute cash back to the investors similar to, what a AAA or a AA bond would do, but build that diversity within the portfolio on a basis that, we are at a 300 to 500 basis points premium to where typically fixed income benchmarks are in the country. So our goal is that, this should be a very healthy, predictable, visible, transparent asset class where you're able to make returns higher than fixed income, but, slightly lower than, taking a pure equity risk, which is a completely different risk proposition for investors. So, our three Ps are based on capital protection, consistent cash generation, and risk-adjusted returns. So from this point of view, every single one of our funds is built on this basis, which may be very different, for another investment manager who, for example, chooses to focus on, let's say, early stage venture debt or late stage stress distressed, or a pure secondary market strategy, where you end up taking, mark to market type risks, or even, some form of quasi mezzanine bet, which some of the other fund managers are doing. And, all of those are individually excellent asset classes, but we come from a parentage where some level of conservativeness and consequently capital protection, is quite key, for all our return strategies. And, within that, this is where, our strategies operate.
So if you were to compare, thank you, this was a very brief answer. So if you were to compare between private equity and a venture debt, so do you think private equity is getting attraction more for higher risk-taking clients?
So look, at this stage, I think it may be useful for me to point out that, let's say the overall alternate investment market, and when I say alternate, it is a larger subset of the private credit market. So private credit, as I mentioned, is credit, first of all. So essentially, it's not just the instrument, but the strategy has to be credit oriented, where you are ahead of equity in the waterfall. Now, when you talk about alternates, which is a larger sort of universe compared to private credit, it also includes private equity. It includes venture capital equity, aside of various other, sort of even public market extensions, whether it's, I'm not talking about the plain long shorts, but, various derivative forms, ability to take currency bets, cross currency swaps, CDOs, and so on and so forth. So it's a much larger sort of market connotation in terms of what products constitute that market. So I would say that, as I said before, an investor, we've seen typically, whether it is a reasonably established HNI, ultra high net worth, or a family office, give or take, any of the large family offices that are emerging in the market as sophisticated investors, or even institutional mandates, whether they are insurance companies or whether they are, I would say, pensions and so on. So, for example, the National Infrastructure Investment Fund, which is the government pension fund, also has a fund of fund, which focuses on stuff like this. So, regardless of all of them, they look at clearly bucketing strategies based on the sort of blended return that they want to create on their portfolio. So, if you look at, let's say, private equity, as the riskiest on the asset class, where there is, clearly you're taking a naked equity bet on an unlisted company, clearly betting on its growth, management competence, integrity, capability, duration bets in terms of 5 to 10 year bets, to public markets, which, obviously you can see returns, but the benefits are high, but the risks are also high in terms of being subject to volatility and mark to market and sudden NAV changes in terms of what has happened over the last 6 to 8 months, to sort of, I would say, private credit funds, which, as I said, are a hybrid, between, let's say, fixed income and where public markets are in terms of return strategies. For example, we focus on, 12 to 13% or 13 to 14% pre-tax return, which is, pretty healthy. If you add the benefit of compounding, that can be real multiples in terms of invested capital, or, to, let's say, a GSEC or a bond market or a AAA market, which is 6.5 to 7.5, going down to fixed deposits in terms of, products that are available, right? So in a whole universe of alternate investing, there are investors, whose risk capability and appetite is very high. So for example, if a family office is formed by the sale of an IT business or, let's say a new age business or a digital company or a media company or, Sachin Bansal, just to take a name, right? Flipkart. So his penchant, his genesis, his DNA is all about, creating new companies, being entrepreneurial, and consequently his risk gravitation would move to more venture, whether it's venture debt, venture equity, maybe some like extent of private equity, mid-market, early stage, as opposed to credit, because, he knows the ecosystem, right? But on the other hand, if you take, sale of a traditional brick and mortar business, or let's just, take, any of the names like, an Emami, which is a very large family office in Calcutta, or any similar name, and we've seen feedback from our own investors. They're saying, public markets and equities is something that, we believe, is there. We think over time, if I have a 5 to 10 year duration, we think that, with benefit of time, I will consistently make averaged out returns. But as part of my portfolio, I need some anchors to ensure stability. So, we've seen a 0% allocation in debt go up to 15-20% over the last 3 to 4 years in these kinds of investors, which are substantial quantums of money. And so, these are investors at any point in time who can cut checks of 5 to 10 crores, for example. So, if, they increase their allocation to private credit, we think that, within that, that is a pretty healthy allocation. We've seen that trend happening. So the answer to your question is there is no one size fits all, but we are definitely seeing a movement into credit in general and private credit in specific. And within that, people have their own choices in terms of whether they want to back a Motilal Oswal, whether they want to back a Sundaram, and people have their biases in terms of, okay, Sundaram is a household name, and I don't think they will do stuff that will lose money for us, or at least they will tell us what they're doing and they won't do other stuff. But there are new age family offices and so on who take a more clinical view in terms of, okay, let me spread my money around. But the overall answer to your question is, it is a very, very here to stay asset class where people are moving into more forms of credit, and they believe that credit over time can actually generate equity type returns, especially if there is a discipline within fund managers to be able to execute their strategies. So we are seeing a sort of evolution in this manner. And this is also honestly, Akshara, being helped by the emergence of, I would say, multiple managers, whether it's onshore or offshore, increasing marketplaces. So you see platforms, including like yours. Whether it's intermediating wealth or intermediating product or intermediating just access. Zerodha, for example. It's revolutionized broking in terms of the way it is historically perceived. So the ability for a 50 lakh to a 50 crore investor to access markets, be aware of trends, get information on a real-time basis is extremely high today. So from that perspective, I think there is a lot of, I would say, opportunities for investors to access these kind of products, and also be aware of what kind of bets investment managers are taking and what culture they come from, and to be able to take informed bets in this manner.
Okay, thank you. It was a very brief answer. So, and investors will have a good idea on it. And when I was knowing about you more, one of your colleagues just said that you're a very honest person and you're a good orator. So, what do you think are the one special quality should a fund manager possess apart from these?
So honestly, thank you to whoever said that. But look, there are people who are way more articulate than myself. And obviously, as a fund manager, you need to be articulate to be able to outline, what risks an investor is taking. So today, one of the things, despite all the disintermediation that I mentioned, is the fact that investors come with certain views, about asset classes. And this really is a so if I went to interior Coimbatore and met with a guy, who's sitting on, let's say, 100 crores, and when I actually pitch a private credit idea to him, he will compare my product with a fixed deposit, because for him, all he knows is fixed deposits on the one end and listed equity on the other, right? But if I went to a Premji Invest, which is Wipro's family office, which runs several $1 billion, they are extremely sophisticated in terms of their understanding of product and minutiae. And if I went to Delhi and spoke to a bunch of investors on real estate, they would come back and say, look at it as that, hey, I bought an apartment or a villa or a flat, and I lost money, or I invested in a fund, which did not inform me of the risks. And despite all of that, say, will I make 20% or more, right? So the levels of sophistication are different. In terms of different kinds of investors, regardless of whether they have money or not. So I think the whole process of selling for a fund manager is one aspect of it, where I think the need to be a little articulate, understand who you're selling what to, whether it is directly or through a platform or a distributor or a wealth management outfit is important. Because from a long-term perspective, you may be able to raise 1,000 crores today, but if you have missold a product, intentionally or unintentionally, I would think unintentionally, and God forbid, things were to go sideways or south, that investor is going to remember that, this fellow came and missold something to me. So I think the integrity of a fund manager in terms of what they sell, what the risks are, what their own strategy is to mitigate it, is something on the one hand, I think that clearly needs, a truthful communication on the one hand. The other hand, and more importantly, I would say, is the ability to manage the business in the risk. I think that is the most important. At the end of it, regardless of what you say, what you talk, how well you communicate, so on and so forth, I think the important thing is to be able to have that culture, that governance, that institutional backing, regardless of however star performer you may be as a fund manager, if the institution that is backing you, has a culture that's different from the fund manager, it is a recipe for, difficulty, right? So if there is a culture that is backing an investment manager to stick, to what he is projecting as risks in the business. So one of the things that, we have been often commended for is the fact that, even in situations which have been difficult, we haven't strayed from our investment mandate, right? So if we say we're investing in real estate with security, with multiple projects, I won't back early stage, we may make life very difficult for ourselves with the credit policy and it may immediately sell. But the more important thing is, are you following what you're saying to an investor and have that discipline to stick to it? So the Sundaram AAA culture, as I mentioned, will ensure that no individual investment manager, fund manager, can take discretionary calls, which is different from what the mandate of the philosophy of the institution is. So if there is a credit policy, we have to stick to it. So which is also why, we're seeing 40 to 50% repeat customers coming from fund to fund to fund. We are now on our fourth fund, launching our fifth. So essentially, we've seen a 40% repeat rate coming from customers only because they've said that, okay, even in difficult situations, you have, been truthful and told me what the risks are, and you haven't done, funky cowboyish stuff, which is different from what you committed and promised to me. So from that point of view, investors committed. Of course, at the end of the day, everybody loves to make money. And so if you're not making money, nobody's going to come and give you money. So assuming that making money is a constant, I think from a longevity and sustainability point of view, managers, who are more institutional in their approach and have consistency in terms of what they are saying and have the conviction to follow that consistency, I would think is the single most important thing that an investment or a fund manager should have.
Thank you, sir. Thank you for that. So with that, we have come to the end of the session. So I thank you in behalf of PMS Bazaar for coming on board and for enlightening our investors on private credit space as well.
Thank you, Akshara. It has been my pleasure, and I'm glad if this has been helpful to even a few investors. Thank you.